Imagine this. You're doing everything right. You have a steady job, you're putting money every month into ETFs like VOO, QQQ, or SCHD, thinking it's the smart, safe way to build wealth for retirement. But quietly, year after year, you're losing thousands, maybe even tens of thousands, because of simple mistakes almost nobody talks about. Hi, I'm Kevin from Kevin Invest Lab. In this video, we're diving deep into the 5 deadliest ETF mistakes that are destroying beginner and even intermediate portfolios across America right now in 2026. These aren't hype videos promising you overnight riches. This is real, actionable information based on how markets actually work. If you stay with me till the end, I'll show you exactly how to fix these issues so you can protect and grow your money the right way. Let's get into it. First mistake. And this one is costing people the most right now. Blindly chasing hot-performing ETFs based on past returns. Every year, new investors see an ETF like the Invesco QQQ or some semiconductor fund that returned 40 to 60%, and they think, "This is my ticket." They dump their savings in without understanding why it performed well. Here's the reality in 2026. Many of these concentrated tech and growth ETFs are extremely volatile. When the economy slows or interest rates shift, they can drop 30 to 50% in a matter of months, wiping out years of gains. The data doesn't lie. According to Morningstar and Vanguard reports, the vast majority of actively managed or hyper-focused ETFs underperform broad market indexes over 10-plus year periods. Fix. Build your core portfolio with low-cost, broad market ETFs. VTI for total U.S. stock market, VXUS for international exposure, and BND for bonds. This gives you true diversification instead of gambling on sectors. Mistake number 2. Completely ignoring expense ratios, trading costs, and tax implications. It sounds small, 0.03% versus 0.8% expense ratio. But let's do the math. If you invest $10,000 per year for 30 years at 8% average return, that 0.77% difference in fees can cost you over $80,000 by retirement. That's real money for your future. Plus, many people don't realize they're triggering capital gains taxes by frequently buying and selling ETFs in taxable accounts. Fix. Stick to ultra-low expense ratio ETFs from Vanguard, Schwab, or iShares. Use tax-advantaged accounts like Roth IRA or 401k whenever possible, and rebalance only once or twice a year. Number 3. Terrible diversification. Even when you think you're diversified. You own 5 different ETFs, but 4 of them are all heavy in Magnificent 7 tech stocks. When AI hype cools or a regulatory crackdown happens, your diversified portfolio crashes together. This happened in 2022, and it's happening in cycles. Real diversification means spreading across market caps, sectors, geographies, and asset classes. Actionable fix. Use a simple allocation. 60% U.S. stocks, VTI, 20% international, VXUS, 10% bonds, 10% small cap or value ETFs. Tools like Portfolio Visualizer or Personal Capital can show your actual overlap in seconds. Mistake number 4. Letting emotions control your investing decisions. The stock market drops 10%, which happens almost every single year, and panic sets in. You sell. Or worse, you see a bull run and FOMO in with everything you have. Behavioral finance studies from Dalbar show the average investor earns significantly less than the market itself purely because of bad timing and emotional decisions. Fix. Have a written investment plan. Decide your asset allocation in advance. Set automatic investments. And when the market crashes, Remind yourself, this is when smart investors buy more, not sell. Now, the fifth and most dangerous mistake: not truly understanding what your ETF actually owns and the risks involved. You buy a high-dividend ETF, thinking it's safe income, but many hold companies with declining businesses and high debt. Or you jump into leveraged ETFs like TQQQ or SOXL for bigger gains without realizing they suffer from volatility decay. They can lose value even if the underlying index goes sideways or slightly up over time. Fix: before buying any ETF, read the fact sheet and top 10 holdings on the provider's website. Ask yourself, does this fit my risk tolerance and time horizon? Start simple and only add complexity once you're comfortable. So let's recap the 5 mistakes. Chasing past performance. Ignoring fees and taxes. Poor diversification. Emotional decisions, not understanding your holdings. Avoiding these doesn't require genius-level intelligence. It requires discipline and the willingness to play the long game. The beautiful thing about ETFs is they still remain one of the best vehicles for regular Americans to build wealth. Done correctly, they can help you reach financial independence. If you're just starting, open a Roth IRA or brokerage account today. Put your first $100 into a broad market ETF. Then focus on consistency over perfection. What about you? Which of these mistakes have you made or seen others make? Drop it in the comments below. I read every single one. If this video helped you, please hit the like button, subscribe, and turn on notifications so you don't miss future videos where we break down more practical investing strategies for 2026 and beyond. Thanks for watching. Invest smart, stay patient, and I'll see you in the next one.